Marvin Barth of Thematic Markets and Seriously Marvin here on the Thematic Edge with my good friend Mark Farrington of the Global Watchtower. And we have a packed agenda today. And of course, the agenda has been even advanced further with the election in Japan of new party leadership for the LDP. And Mark, I'm going to ask you about that because you are my resident and always go-to resource on Japan. So, talk to me about who Prime Minister Takaichi is, how what factions within the LDP she represents, and what we should be looking out for from her.
Well, I must say, like most people in the market, I was surprised at her election. The message out of politics in Japan for the past year has been similar to that in the US and Western Europe, where the people are unhappy with the constant rise in cost of living, and there feels to be a kind of a detached approach from the elites within government. And so, you know, candidates like Koizumi are not only were young and articulate and look good in front of the cameras, they were pushing a more populist message of focusing on inflation and the cost of living crisis and on the struggles of the common man. The election of Takeichi unfortunately, sounded a bit more like LDP circling the wagons and focusing on party unity rather than the public message. I mean, she is an extremely experienced and apparently, gifted policy analyst and strategist, and so there's this hope that she will bring some higher caliber, thought leadership to the role. But I think that the LDP is missing the point again that the people just feel, government is detached from the plight and suffering of the ordinary man, and so it's not going to win broad support outside of the LDP and the public, but maybe it's a step in the direction of greater LDP unity. Uh, so that's sort of the general politics of it. But in terms of what I care about, which is always focusing on the BOJ's
There
ability to
were some
normalize.
big, yeah, there were some big market moves this morning. So, why is it that the yen sold off here? JGB yields are up a bit. They're not really out of the line of the
Yeah,
trend higher that they've been on, but still,
yeah.
like the direction here, I would not say is positive for Japan. So the market reaction hasn't been thrilling.
Yeah, well, initially, of course, the stock market shot up. So, I mean, the simplistic reaction that the market was, riding up on Sunday for the market open was that stocks would be up, currency would be down, and that the outlook for greater fiscal stimulus was now improved. And so markets, I think, knee-jerk reacted that way primarily because the market was wrong-footed. Had Koizumi been elected, he was perceived to have been hands off on the BOJ, and the BOJ had been building up the rhetorical, preliminary steps for delivering an October rate hike. So people were building yen longs and were becoming a little bit more comfortable at the long end of the bond market and things like that. So they had to get stopped out first thing this morning. So I think part of that is positioning. We'll see how much of that market reaction is retained. But yeah, getting to this interpretation of what she means for BOJ policy, she, in her acceptance or victory speech rather than acceptance speeches after the election on Saturday, she unfortunately came out and used the same, touchstone topics that were popular, several years ago, when the Kuroda regime was still in place. The Abe Kuroda regime was what was driving policy coordination for the previous 10 years. and led to the most extreme form of monetary stimulus in Japan. And we had well and truly moved on from Kuroda's regime with Ueda over the last couple of years. And it feels a little bit to me like Takaichi hasn't updated her rhetoric. Yeah, she gave a speech that she could have given 2 years ago. We are no longer in a state of deflation. We are no longer a stagnating economy in Japan, and our risks are very different now. And she didn't deliver a speech that showed that she was paying respect to those risks. You can't really run on a platform of cost of living crisis and then come out and say, we're going to invest and stimulate the economy, and the BOJ needs to take its direction from the cabinet in terms of monetary policy. So the market has punished her straight away for those comments, and I think she will modify the message because I really just think this is just the one area she's not that strong. People argue that she's a policy wonk and that her portfolio has given her the experience, but it's been cabinet level posts. She hasn't been a head of a ministry, and it's been focused on policy coordination and development finance and national security type of economic development. It has not been, a path through the Ministry of Finance and an understanding of financial markets and capital markets. So hopefully she appoints someone in the cabinet who will bring that expertise and sensitivity to her, and she can rein in the message.
Well, so, you know, that broad agenda, though, this idea that the government is going to be in the driver's seat in the economy increasingly. Um, that is a theme that I think is transcending Japan. And, it's very clearly something that we're seeing increasingly in the US and even in Europe. I mean, I think there's two parts to that. One is the you know, intervention of the state in the real side of the economy and taking a more forward view of how the economy should be structured, largely along, I would argue, national security lines. And this is
Yeah.
something that in my piece at Seriously Marvin this week, I talk about the interaction between geopolitics and um, uh, uh, AI in particular, and how state involvement changes how the way you should think about that. And I think that's very clear in what she's talking about. But the other is, as you allude, it goes back to the Abe Kuroda. Well, let's lean heavily on the central bank to do things, and this is something that I think you and I both have concerns about, and it's something I wrote a lot about last week in the context of the US, both in terms of, what we learned from new Fed Governor Stephen Miran's speech, but also in terms of, a much more fundamental, in-depth analysis of US employment in my thematic markets piece. What are we actually seeing in terms of supposed weakness in the US labor market and what that means for inflation? And so that combination of, you know, the potential for government intervention or fiscal authorities intervention into central banks, plus what I would argue is, I think, a much more significant problem of central banks themselves underestimating the inflation challenge they face, um, is a real serious issue here, and that seems to have been brought to the fore by Prime Minister Takaichi.
Yes, I think you're right. I was not intending for her to bring it to the fore so dramatically as she has, but now that it's happened, we've got to take that on. Look, I wouldn't say that we're outliers anymore. I mean, I think the market in general is starting to embrace state involvement in the economy in the so-called, Western capitalist countries. And but I'm sure that it's just not clear how it's going to play out in terms of winners and losers in the stock market, effects on inflation, central bank independence, etc. But the trend is there, and the trend is only going to continue. It's being driven by this geopolitical imperative. So it's not it's not a partisan issue that will pass with the next government change. We're sort of stuck in this structural trend for 10 years plus. I think some of the confusion comes from, okay, if I accept that the state is going to be more involved in the economy, what are the different forms? So there's hope that Takaichi, for example, dials up investment in the military industrial complex in Japan. So, more than 2% of GDP in terms of the military defense budget, etc. But there isn't the focus like you have in the US about these crossover investments and things like AI and in civilian and nuclear power and biotech and all these other sort of leading edge areas of R&D. Are those going to see a big injection of state capital in Japan or not? Those questions have not been asked yet. And I do think there is a way for the state to lead that kind of investment that doesn't actually require it to become more fiscally loose. It can be a redirection of the budget. It can be done in a way, private-public partnership, so that it's not so much burden on the government. So I think, like in the case of Japan, they need to strike that tone because they're in a worse fiscal position than the U.S. is. If they can't come out with a big beautiful bill at this point in history without seeing JGB yields, become disanchored and shoot through the roof. So they have to be more intelligent about it. And I hope I hope she has a good wordsmith working with her in the cabinet that helps her to strike the right tone because yes, Japan needs to spend more than 2% of GDP on defense. Yes, Japan needs to match this kind of investment on traditional military hardware that we're seeing from all of the US allied nations. But it also needs to start to lead some private-public partnership in the AI and high-tech space that we've seen in the US and Europe. And how they do that without upsetting the long end of the bond market is going to be very tricky. I think it'll take time. Like it's not something she's going to come up with as a grand master plan in the first 3 to 6 months. So that's what I'd say about Japan. Relating it more to the U.S., I think that I'm very intrigued by the points that you're bringing up in the labor market because I don't understand exactly how we run the economy is a bit harder with the labor constraint and not have inflation. And so it's hard to reconcile these two, opposing desires because the economy is generating inflation now.
Yeah.
How can we run it harder just because the labor market isn't the engine of growth in this particular cycle?
Yeah, I mean, I think this is the critical issue, and I have to admit I'm quite perplexed by markets because um, you know, while you hear a lot of rhetoric about markets being concerned about usually much more. I mean, obviously, it's just Prime Minister Takaichi has just been elected, so we're just hearing this now with her, these concerns there. But in terms of President Trump, right, and his comments on uh, interest rates need to be much lower, and putting Stephen Miran on the board, who gave the speech last week that miraculously defined that given the change in circumstances, actually our star should be much lower than we thought, and you need much lower interest rates. And that was a topic that I raised in last week. Seriously, Marvin, is did we actually learn anything from that? And I think the only thing I learned from Stephen Miran and his speech, and also going back and looking at his Senate testimony, is that he's much more clever than I thought. That's actually just, an underestimation, and not spending enough time looking at him early on and just thinking, oh, this Mar-a-Lago Accord is clearly insane, and only somebody who doesn't understand anything about markets would ever come up with something ridiculous like that. But I'm
Yeah.
looking back, and now I realize he is actually a very clever economist, but he is very much in this mold of, ironically, it was Paul Krugman who is like, the poster child for the economist who is talented, but literally you just have to ignore everything they say because it is 100% politically driven, and that they will use their intelligence to shape an economic argument to whatever endpoint they already wanted.
Yeah.
you know, Stephen Miran is exactly one of those. He's a Jason Furman. He is an Austin Goolsbee. He is a Peter Orszag. All these people on the Democratic side. He's the MAGA version. You know,
Yeah.
the commander in chief says he wants interest rates here. I will come up with an economic argument for why interest rates should be there.
Yes. No, you're spot on with that. And I think I mentioned in our last podcast, my understanding of what Trump wants is a housing refi cycle because we've had a couple of years without price gains, and people have had to sit through some rising mortgage rates. And it's always good for midterm elections if you have housing in an upswing and people feeling good about their household balance sheets. So I thought he erroneously imagined that cutting short-term rates this time around would produce lower long-term yields like it had in the past. And I was arguing that if mortgage rates don't go below 6%, you're not going to get much of a refi cycle. I mean, it's still early days, but that's sort of what happened. They got down to 6.25, I think. They bounced off of that. They've come back up now to 630, 640. So, if there's not much of a refi cycle and Trump sees that lower short-term rates do not produce lower long-term bond yields, I'm hoping he will adjust and maybe he will send a new directive to Governor Miran. But that's not the way to get the long end down. And this is so I see all these conflicting objectives. Run the economy harder, but we have labor market constraints. Get long-term rates down, but we can't because we're above target on inflation. So these conflicting goals need to be resolved somehow.
Well, I mean, I think like all things Trump, there's a lot of confusion that is sometimes intentional and sometimes due to a time inconsistency problem. And so I've had a view for a while now that I think is quite um, contrarian. Um, Although we'll probably come back to this, maybe not, looking at market prices. Um, is that his rhetoric around the central bank needing to have lower rates right now. First of all, let's remember that this both his message and Stephen Moran's economic arguments are 100% diametrically opposed to what they were before he got elected. So
Yeah.
last year when President Biden was the president, it was all about inflation's too high, the Fed is cutting rates too early, R star is higher than the Fed thinks, all of those things from those two, right? If we think about Miran as sort of speaking the voice of President Trump in economics terms, Homo economicus terms, um, then how do we explain that switch? Well, I think one of the defining features of Donald Trump is that he is always going to say what he thinks is best for him at that moment. And one of the things that I think is, I highlighted this, when he was elected, that Trump 2.0 was going to be very different from Trump 1.0 because, in my view, what he's playing for is the long run, his place in history.
Right.
And so to this point, I don't think he wants to go down in history as the president who caused the hyperinflation. Like,
Yeah.
I don't think that's anywhere on his bingo card.
Yeah.
And so so it brings you back to this question, well, is he stupid? Does he not understand this? And then, you have someone like Scott Bessent on his team, and I don't know what your impression has been, but it seems to me that Scott Bessent is the one cabinet member who seems to actually have an impact on his policy direction, right? Like
Yeah.
rather than top down to Scott Bessent, there's some Scott Bessent up to Trump um, influence here. And remember, he's the one who's been appointed to find the next Fed chair, right?
Yeah.
And
Yeah.
Scott Bessent clearly understands, like you and I do, that the long end is not going to be treated well by these sort of things. So why was he doing this? And I wrote a piece earlier this year, and I have to say, given his rhetoric, I don't have super high conviction in this, but I think the easy explanation that actually fits the facts is that it's been in President Trump's interest to hammer the Fed and say that they are being too tight right now,
Hmm.
but that won't be necessarily be the case next year when he gets to appoint people. So right now, and especially, I think earlier this spring when inflation was actually falling, this was a great way for him to highlight to everybody, hey, I got elected president. Look, inflation has fallen. I brought this to you. I'm the greatest president ever.
Hmm.
Right now, it is also the case that if anything goes wrong over the next year or two, he can always point back and say, see, I told you the Fed screwed up. This is 100% the Fed's fault. Those guys didn't cut rates when they should have back when I brought inflation down, right?
Yeah, I think you're right. He's got that option now. He's created that option by making the Fed a potential fall guy. But backing up a bit to your point about Basant, I think you're right. He has been entrusted with telling Trump or explaining to Trump why the markets are doing what they're doing in response to his policies. And I think that thankfully Trump has listened to him, and probably in the way that only a seasoned hedge fund manager can. He's really like giving him the hard facts about why the markets are digesting the pronouncements the way they are. So I think that's a very good point that if Besant can convince him that there's no way to get long-term interest rates down through excessive monetary easing when inflation is this high, we're just going to be patient, then Trump will pivot and try to focus on other low-hanging fruit like cutting enormous amount of federal waste and expenditures that are close and dear to the Democratic Party's heart, etc., and then try to win some points on fiscal austerity in these other areas as a way of helping to control the long end. And then Besant will, of course, continue to keep duration short in terms of treasury issuance. And they will, fiddle around all the edges to try to hold long-term rates down. But I just don't think they're ever going to get them to drop to the level that will get a proper refi cycle. So I'm really interested to see what that pivot will be next year. You've seen already Trump floating trial balloons on giving a kind of tariff dividend to the general population. So there might be some other attempts to win, household support ahead of the election, in lieu of the lack of a housing story. And that would be positive, in my opinion, honestly, if he could find another way to seek voter support other than going for a housing refi cycle. Because I just think the cost of doing that in the short term will come back to bite
Well,
them.
I don't think that, I think housing refi is useful. Um, I think the reason there will be a pivot next year. So, like, I talked about it, the incentives now are for him to talk things down.
Yeah,
The incentive next year changes because, you know, monetary policy is not immediate. It's going to take time to filter through the system. I think even he gets that. And certainly if he doesn't, Scott Bessent will make this clear to him. And so as a result, he's not going to help himself in appointments next year with the midterm elections through the Fed, right? And in fact, if you look at which voters hate inflation the most, it's his voters.
True.
So I absolutely think that his incentives shift to appointing hawks next year, regardless of his rhetoric. And one of the things we know about President Trump is he can turn his rhetoric on a dime. Um,
Yeah.
it's just, what he said yesterday doesn't exist anymore, right? And
Mm.
we've learned from Stephen Miran that there will be a new economic argument immediately tomorrow if he needs to justify higher rates. This is what we saw from that is what I learned about Stephen Miran is he will come up with a cogent economic argument for what President Trump wants, right?
Well, I think that's a very astute and optimistic outlook. I do hope that pivot takes place, and I hope Percent appoints a Fed governor that we can all trust and anchor the long in, because I don't see it delivering either economic or political gains for Trump in 2026 either. I think you're spot on
Well,
that.
so look, I think you've raised some interesting points, and you're right. It is an optimistic outlook, and as I said, I don't have super high conviction, but the so far I've been relatively good at predicting Trump policies by thinking about what is best for him,
Yeah,
what fits what he thinks is best.
yeah.
And sometimes that's for him best personally, sometimes that's what he thinks is best for America, which is going to put him on Mount Rushmore someday. you know that
Yeah,
that's things. But I think you raised a couple interesting points there. One, Doge wasn't a particular success, but they're giving a second bite at the apple right now in terms of uh, the government shutdown. And, unlike his Democratic predecessors, this administration seems to be embracing the Democrats doing
exactly,
and
exactly.
saying, wow, this is our opportunity to do what we always said the Democrats could do, which
Hmm.
is we can prioritize payments. We won't
Exactly.
default. We'll make money. We'll send money to bondholders. We'll prioritize the military and all that. But all those programs we wanted to get rid of anyway. Yeah, we're going to cut those off because it puts them in a great position to be able to show the Republicans in Congress and
Yeah,
get them on board to cut further.
yeah.
Say, hey, we've done this. And so I think that's one really important point. The other is to your housing point, like, look, I think, and you actually clued this into me, this was in one of our thematic edge conversations, but in one of our previous conversations privately, you and I, before we started the thematic edge, you made this point about relative prices and that the Trump administration was going to focus on what were the things that his voters cared about in terms of relative prices. And so, the obvious one is their wages in working class things. So,
Mhm.
limiting immigration and, putting up these tariff walls to produce more stuff in the United States is going to put upward pressure on his voters' wages in relative
Mhm.
terms,
Yeah,
right? Relative to Wall Street or to others.
yeah,
The other is this point about you know what are your essential goods, and I think this is one of the key points you made is like what are the things that if you are a middle class or lower middle class household, what is it you cannot avoid? Housing, medical, gasoline for
those are
commuting,
the big three.
those things, if you get those prices down, those people will feel much better. And so actually, um, lower housing prices is not just a function of mortgages. It's in part about building, so removing restrictions, and they've been pressing for that. That's much more a local issue, but they've been trying to push that elsewhere. And if you look in a lot of the sort of states that are seeing the reindustrialization, actually housing prices are doing fine in those places. If you look at the pressure they're putting on the pharmaceutical companies to like
Yeah,
reshore production, to stop subsidizing foreign medical prices at the expense of American consumers, which has been American policy for decades,
yeah,
right? They're unwinding that. And then, drill baby drill, pushing the Saudis to do this. And, there's a foreign policy component to that as well. But I mean, look, oil prices are at
absolutely.
multi-year lows. It's working. And then the final piece is that yes, they raised tariffs, which is falls more heavily on middle class households. But if you look at all of the tax cuts, I mean, there was one that was for businesses. It was full expensing, but all of the tax cuts that they pushed through, and I'm not talking about like extending the previous tax cuts from
Yeah,
2017. That was baked in the cake. Everybody knew that was going to happen anyway. Ignore those. The
yeah,
new tax cuts that came in with OBA were 100% focused on the lower and middle classes,
yeah.
taxes on tips, taxes on overtime, and social security taxes. This was all about giving his voters extra income. And so I think they actually are very focused on those things.
I think that is an excellent point. I think there has been too much of a
Well, it was yours originally, but
yeah, no, but as always, you articulate my views better than I do. Um, but as always, the easy lever for government to reach for and pull strongly are the macro levers. And I think in this cycle, the macro levers are not available. We exhausted the macro levers after COVID. Excessive monetary stimulus and excessive fiscal stimulus. So neither of those big macro levers are available. So it does require this micro sector by sector, or in the case of Trump, constituency by constituency, adjustment to the policy to ensure that you get the improvement in standard of living and real wages and household incomes, so that you have the successful midterm election outcome. So yeah, if it's not available through a big refi cycle and it's a problem to get long-term interest rates down in this environment globally, which I think it will be, then they should pivot to these micro measures and try to make further progress on those, including follow through on the Dodge ethos. I consider Dodge to have been very successful, not because the amount that they managed to cut from the first year's budget, which was already in train when they took office, but I think it changed the mentality in Washington. And this Dodge ethos actually reverberated around the world. And this Dodge inspiration it can be seen in every opposition party's strategy and politics around the world now. So I think, have turned the corner on excessive government spending, and each year we should make progress. I'm not sure which will be the high priority sectors in 2026, but yeah, this government shutdown has created an opportunity, and I think the Trump administration will leap on it, and then they will,
yeah.
do the polling after to see what was successful and what was not, and then really push that accelerator stronger through 2026.
Yeah, no, I think so. Now, I do want to return to that point about central banks because, look, maybe my theory about Trump's incentives at time inconsistent incentives will explain where he is right now and why you might get a more hawkish Fed than I think certainly the commentary expects from the Fed under Trump. But I've made the point repeatedly in a lot of the stuff that I've been writing and I alluded to this analysis earlier that I did last week in thematic markets about employment, that the greater worry is actually the existing Fed itself. And I think you've made similar points about the Bank of Japan. And there's, a clear crossover here in that Japan led the way in terms of understanding the or showing us what a declining workforce was going to look like.
Yeah.
But in the US, if you look at all of the data, second quarter GDP was in the US was revised up again to 3.8%. The Atlanta Fed nowcast of third quarter GDP, which we should be getting later this month, was running at 3.9%. If you
Gee.
look, even including the negative growth in the first quarter based on the big imports restocking, you still have year-on-year growth running at 2.25%, which is almost a 0.5% above what the Fed considers US potential.
Yeah.
The previous year, it grew at 4.4%.
So no payback.
The previous year to that, it grew at 3%. Like, this does not look like an economy that is facing, quote, restrictive rates. And yet the Fed cut rates. I've described that very clearly as a policy error when they cut last fall and winter. I described the latest one. But what I think is really interesting is the labor market component, because this time they did lean on that, well, we're concerned that the labor market is giving us signals about weakness in the broader economy. And yet, as I said, every other real indicator, whether it's capex spending, intended capex spending, which is now over $2 trillion in announced new capex in the United States year to date.
Mm.
Um, uh, Whether it's retail sales, any of these things are telling you the US economy is actually on fire. And then you have this one indicator, non-farm payrolls, that is slowed.
Hmm.
And yet, one, the same people who were telling you we were going to have a recession and were totally wrong,
Hmm.
were also telling you that you were going to get all this inflation from
Yeah.
lack of immigration.
Yeah.
And what have we seen? We've seen that immigrant participation in the US economy has gone down. And so we are having to focus more on the native born population growth rate, which is not negative like Japan. But, my calculations are it's really only about, we should only expect it to add 25 to 50,000 jobs a month in non-farm payrolls if we're at full employment. And, by most measures, you would say we are at full employment. But then you add to this people like you and I, and neither you or myself are in the United States, so we wouldn't be counted in this, but this whole solopreneurship
Mm.
phenomenon. When I go through and like dig into the data on business formations by individuals who are not employing others and things like that, and those data are out there. I come up with an estimate that, yeah, that's actually about 30 to 50,000 jobs a year. So if you put those two facts together, it's basically saying that solopreneurship should be absorbing all the native labor force. You've cut off immigration. This should imply that a fully growing US economy should have roughly zero non-farm payrolls growth because those solopreneurs are not counted in it. And
Hmm.
and yet the Fed is concerned about labor force growth that is actually still well above that. So I'm much more concerned about what the actual ethos at the Fed is than I am at this point about what Donald Trump might do. And I think there's similar sorts of issues at the Bank of Japan right now.
Yeah, I think you uncovered a very important development in the modern economy. It triggered a lot of reflective thought on my part, and I was, I had a couple of questions. I thought that initially central banks probably believe that the solopreneurship, as you call it, spiked during COVID as we were all forced to stay home during the lockdown, and then there would be this gradual fade as offices reopened, and there has been this trend in the last 2 years where businesses have been demanding people to come back to the office or resign. Even Dodge produced that type of effect in the federal sector. So I think perhaps that many people had written this off as a one-time phenomena associated with the lockdowns. And I think what we've discovered and what your data actually confirm is that the big bulge of forced lockdown was a once-off factor, but a lot of people discovered a new business model during that phase, and now it has become, ingrained, and it's a part of the macroeconomic landscape now. Particularly, you see so many, college graduates coming out of university without any job opportunities. The solopreneurship path seems pretty attractive, actually. So I think it will gain momentum as a data cohort. And I know I already asked you, have you seen that pattern across Western Europe, for example? I think this pattern is not as prevalent in Asia, but it should be in Western Europe. They had a very similar reaction to lockdowns to America. And so, maybe that's a sector we can all focus on. I think I have the questions in my mind about the labor market are if onshoring and localization, as you like to call it in your themes, does take off, um, we should start to see some, job growth in the manufacturing sector. And if AI is a labor substitute, it feels like it should be more punitive in the service sector than the manufacturing sector. So I'm just wondering, when do we see the first fruits of the massive investment boom that we've seen in the AI related sectors? And are we going to see a pickup in manufacturing employment at some point that we can all, pin our optimistic hopes on?
Well, manufacturing employment, bottomed out some years ago, right? So we already have seen this renaissance that's starting to take place. But I think you do have to temper your expectations about how many jobs are going to come out of this. I mean, a key point of localization is that it's being driven by technology, automation, that, it's actually cheaper and more effective to use robots than to use humans. Hence why you don't want to use, the cheapest Bangladeshi that you can find. You want to use the cheapest robot you can find, some located somewhere near where your consumers are, right?
Mhm.
Makes much more sense when you can do that. So look, we already have seen a bottoming out and a picking up of manufacturing jobs in trend in the United States going back several years now. So I think that's already occurring. Um, how that relates to service jobs, that's actually an interesting one because I think, you've actually raised this point before, that, in Japan, it's services that are booming, and yet they don't have the labor. Their employment is actually falling. It's actually negative growth because, you know, there just aren't enough Japanese. They're, falling out of the labor force, and um, the population itself is shrinking. And that is really a lot of the AI phenomenon, right? The AI is replacing a lot of these service sector jobs, and I think that is to some extent that's another issue that I touch upon, but I do think needs more work in terms of the US labor sector, which is the point you raised about the rising unemployment among youth, right?
Mhm.
So college educated young people have seen, if you're going to look for any sign of actual real weakness in the US labor market, that's the key segment right there, right? Like actually non-college educated high school graduates and, you know, some college like technical degrees or AA degrees, those people have not been affected, right?
I
So
see.
that speaks to your manufacturing point that those people are going into jobs that are doing things. I think the problem we're facing is that, you know, we have been telling so many people the only way to get ahead in the world is to go to university. And we're telling a lot of people who, frankly, aren't really university quality people to do this. And then they're going into majors that are the only majors they can complete, like, peace and conflict studies or something like that. And then you say, wonder why they're not getting a job offer. Well, yeah, because you have no skills whatsoever. Whereas we would have been much better off telling these people, like, if you look at the backlog um, of or the job deficit, like job openings relative to available skilled labor for like electricians, for welders, for machinists, all of those, they're off the charts. And by the way, if you look at their wages, they're significantly higher than
Mm,
most college graduates right now, right?
yeah.
And this is a labor mismatch story. And I think there's a part of this, right? And it's going to take some years for that to develop, right? That we are going to have to shift our labor force skills. We're going to have to tell all these people that, sadly, we told to go out and take, $200,000, $300,000 in debt to go get a worthless college education in peace and conflict studies. Um,
Mhm.
uh, to go back and say, well, actually, why don't you go back and do a 6 month technical program to learn how to be a welder? Because you're going to be paid a lot more, right?
Yeah.
And
Well, actually,
unfortunately,
there's
that's
two.
part of what's going to happen.
Yeah, that'll be interesting to watch happen.
It's
I
not going
think,
to be politically fun.
yeah. MAGA will make posters along those lines and run them in the midterm election. But there's two trends in Japan which can end up being useful for predicting in the US because Japan is always, in terms of demographics, a few years ahead. But service sector profits are through the roof because Japan has a highly committed level of service ingrained in its cultural mentality for particularly hospitality sector and other domestic travel and things like this. And so they have actually, defended those jobs and held them even as, top line revenue and volumes declined. And what has happened is through the incredible weakness of the yen, we've had this huge influx of foreign visitors that have driven the volume levels up and finally made that minimum level of critical size of service sector employment profitable. So they didn't need to hire a lot to adjust to that increase in volume because they actually maintained that labor through the soft period in demand, and that has caused profits to boost and go through the roof and allowed wage growth to take place. And the other interesting fact is that you know Japan isn't like a call center, service sector type of economy where AI is going to hollow and carve it out. Whereas I think the US is more exposed in that area. Most of the AI analysis that I've read is much more deflationary for the service sector than the manufacturing sector. And so that trend is yet to come. So Japan is a little bit insulated by that. And I just think that you know what we can potentially see is a sort of wage improvements for the service sector, but fewer employed. In the same the way that we saw in the manufacturing sector, where higher wages but fewer employed, and that may actually finally allow Japan to overcome this constraint in terms of potential growth that it has. As I mentioned to you a couple of times before, the BOJ is still showing output gap as negative in Japan when a nominal GDP is is near its highs for the last 5 years. So I just wonder how long that transition is. Is this a story that can produce gains in 2026, or is it something that is really very, very long? This constraint of the labor market growth, even if it's higher wages but less jobs, is that an inflationary story or not, or a disinflationary story for 2026?
I think it definitely is. Like, look, a big part of this is productivity gains, which, should feed through to real wages. But there's no question that to your original uh, point earlier, should you really be trying to run economies super hot right now when they already have a lot of impetus from other things? And I think, the whole localization drive plus the transformation, reindustrialization of Western economies is already adding to a very strong capex boom. Um, uh, you know, should you be trying to achieve 100,000 a month payroll growth in the US or, positive payroll growth in Japan? No, like that doesn't make any sense. You are just putting upward pressure on the scarce resource, which is going to feed. The only way that can happen is through rising prices for that, i.e., rising wages, which will ultimately affect broader price in inflation if you can't fulfill that. And we are seeing, I mean, this is one of the reasons why I identify in, this is kind of economics 101 is that, when it's the demand curve shifting back, prices fall. When it's the supply curve shifting back, prices rise, even though output falls. Well, what's happened to wages across industries as the employment has fallen? Well, actually, the industries in which we've seen largest drops in employment or slowest growth in employment in the US very clearly are the ones with the highest wages. This is a supply problem. This is not a demand problem,
Yeah.
right? And so I think this is very clearly inflationary, and that's why I say we've got to be really worried about actually the existing philosophy at central banks like the Fed, like the Bank of Japan, like I would say the Bank of England, the ECB. They all seem to have the wrong philosophy. They are really playing from an old playbook that really does not fit the world that they're managing policy in. And I think that's something that really concerns me about markets. So markets have been very concerned about, equity prices or things like that. Um, but, you know, I think there are good reasons to be much more positive on equities here. And I say that expecting rising wages to cut into margins. And so I don't think I'm not as positive on equities as I have been. But in relative terms, I'm much more concerned about bond markets where I see real rates. I mean, if I look at U.S. real rates here, the 1 year real rate has fallen down to just over 0.5%. To 2 years are at 0.75%. 5 year real rates are at 1.25 percent, which is, actually relatively within the range of where they've been. But, these were closer to 2-3%, which would be more in line with what we're seeing in real growth in the economy
Yeah.
just, a year ago. Um, and then I look at break even, what markets are pricing for inflation. And 1 year break evens at 3%. Okay, fine. That seems fair to me given where inflation is and the fact that inflation is accelerating. But 1 year inflation or 5 year inflation at 2.4, 2.5%, basically their long run averages, like
Yeah.
seems insane. And forget about any risks you have from President Trump or other politicians. Just think about what these central banks' policies are doing in the midst of strong economic growth and weak labor force growth. This has to end badly. And yet, this is not being priced by markets at all. This is the market that I find is the most concerning.
I think you're right. We talked last podcast a bit about vigilantes, the absence of
Yeah,
vigilantes, and I was mentioning that the vigilantes are showing up in different areas. They're just not there along the bond curve. I would say the area where they're most absent is on inflation expectations. I really think inflation expectations should be higher as well. And this is why I was trying to relate the Japanese case to the US case, because in Japan, the household's response to inflation so far has been this increased consumption of services and a decrease in consumption of traded goods, because that's where the inflation bubble has come through. They clearly responded through substitution on a limited household budget by consuming more services. And I just wonder if that's the kind of optimism that these investors and break-evens have, that they think that there's some disinflationary force in the service sector in the US, either driven by AI or whatever. I can't exactly rationalize it, but it's not based on current market conditions. And service sector inflation has been the sticky part of inflation in the US. It's the opposite story of Japan. So yeah, I cannot understand this. I think inflation expectations should be higher. I constantly quote, the Tankan's corporate survey on inflation expectations as a challenge to the BOJ, because the corporate sector keeps pricing, yen weaker and input prices higher every year. And they have this, operational view of inflation always going up. It just hasn't translated into, market proxies like break evens and things like that. And I don't know what the demand supply and the bond market for those instruments are that seems to be creating this anomaly. But it's not a very useful proxy for future inflation anymore.
no, it's definitely not. And I think this is actually a really critical point, is that um, you know, there has this cult of the market always knows, which is kind of ridiculous, right? I mean, why do people like you and I have jobs or have made a living in markets if the market always knows, right? Because you and
Yeah.
both have, in our own different ways, long histories of correctly calling the market, getting it wrong.
Yes. No,
But
absolutely.
fine, there is this cult of, well, the market knows, and the bond market, above all other markets, this is infallible. Well, the bond market's inverted yield curve signal failed for 3, 4 straight years now, right?
Absolutely.
Um, and the other thing is that on inflation expectations, and remember, this is what sadly Jerome Powell focused on in the press conference a couple of weeks ago,
Yeah.
is market inflation expectations are still low. At a time when the University of Michigan survey is at multi-decade highs. Okay. Consumers are the people who actually create inflation, not bond traders.
Yeah.
And bond traders predict it, but bond traders have done a terrible job this cycle. They were totally 100% wrong about inflation in 2020, 2021, and 2022.
Yeah.
And they have consistently under or predicted inflation throughout the fall. Yes, they called that it would come back down, but they didn't call the level. They keep getting it wrong.
Mm.
So this insane focus on somehow they know what they're talking about is just wrong. They are flat out wrong. They've been wrong.
So does that mean the 2026 story, I mean, the market risk story is inflation? Because, historically, we spent a lot of effort trying to predict financial crisis, and we had a lot of bottoms up thematic work that we would do to try to predict crisis. But the shortcut, the easy way to predict financial crisis was always if you could predict a cross asset class rise in volatility, because it was a catalyst that cut across everything,
Yeah.
or across asset class rise and inflation. I mean, those are the two catalysts that always give you a market correction, at least, if not a crisis, when they catch the market off guard. And vol sellers continue to sell any spike in volatility, and break-even investors continue to buy any dip in a spike in inflation expectations. So it feels like we're setting ourselves up in 2026 for a crisis that's going to be triggered by either a spike in vol, as I keep warning, through an unexpected geopolitical event, or perhaps a more traditional one where the inflation miss comes back abruptly, it catches in one off guard, and we get that across risk asset sell off. So,
I think that is a serious risk for 2026. I think, it's usually where people are not looking, right?
yeah,
And so, the piece that I have out in Seriously Marvin this week touches upon markets' concerns about overvaluation in U.S. equities,
yeah,
and how this time is not like the dot-com era. I mean, first of all, just if you look at pure numbers, like, people want to use P's. P's are adjusted by, what real interest rates are at different times, right? So
mm,
P's are not a great measure. Looking at the equity risk premium, i.e. the additional yield earnings give you over equity earnings give you over the real earnings you can use from treasuries. You know, equities are not cheap. They are relatively expensive. I mean, if you look at on a forward basis, we're roughly in the sort of 20th percentile of equity risk premia. So 20th percentile, low.
yeah,
Um, uh, uh, since my data for earnings start back in 97. If you look at the Schiller long run uh, PE and convert that into an earnings yield, we're at about 1.5%, which is roughly its 24th percentile over what is that, 150 years of data. So,
yeah,
bottom quartile, but
yeah,
again, not terrible. To compare this back to the equity bubble, the dot-com bubble, we were not at levels um, this high in terms of equity risk premium in 1997. So even in 1997, 3 years before the bubble bust,
yeah,
you actually had worse valuations than you do now. So one point is the valuations, yeah, they're stretched. Yeah, they're not cheap any longer, but they're not crazy terms like they were in, say, 1999 or 2000, where the forward equity risk premium actually got negative, right?
yeah,
And then the second thing I think is really important is um, this time is very different. And I know that's a very dangerous phrase to say, but the geopolitics are very different. So in 1999 and 2000, the US was the world hegemon. There were no international competitors to US firms in the dot-com bubble. There just were not. There,
yeah,
there were none, zero. So the US government could gladly see some of its champions fail because you knew the winner of the race.
hmm,
It's like the final is all Americans at the Olympics, right? You're going to win the gold. You don't care.
yeah,
Well, who cares whether some of these guys lose? Doesn't matter. This time it's very different. Now we are talking about, China is right on the heels of the US in terms of AI supremacy. And AI is the ball game, not for markets, it's for the military, right? Like AI, what this is all about is basically creating God.
yeah,
You cannot afford to let another country create God before you.
yeah,
They are not going to allow these companies to fail. They are not
y-
going to stumble.
Yeah, I think you're spot on that. I mean, I've been flagging not necessary valuation on the equity markets because they keep delivering, the Mag 7 keep delivering on earnings, but
Exactly.
on the, on the concentration aspect.
Yes.
So, like every bubble, well, the bubbles are created based on some very rational thought. And so I think it is perfectly rational for the market to be concentrated.
Yes.
We're extremely late cycle, and I know you and I were looking through Bank of America's top 10 ETFs as well. And if you look at the sort of top 6 or 7 thematic ETFs that are performing, they all have built in a kind of geopolitical risk, inflation
Yes.
risk component to them. So the market or the risk appetite is there, and the risk appetite is being pushed into a concentrated sleeve of stocks, some of them being AI and geostrategic champions, as you mentioned. But nevertheless, it's still concentration. And so if there isn't a shock, that's a lot of people who own the same thing stampeding for the same small door on the way down. So it's not so much that the concentration is irrational. It's just concentration always sets up market for disruption. I've been trying to focus up more on that because I agree with you. The state involvement in the private sector this time around, which is the very different feature, when we say this time is definitely different, is rational. It's early days. It's going to continue for another 10 years, and every country is adopting the trend. So it's not an anomaly. It's not an odd Trump policy. We have public-private partnership in everything from infrastructure to military to AI across the world now. So people own the right companies. It's just that concentration risk always makes me, want to prepare for a disruption and then catch that stop loss behavior that comes out of it. So I agree. It's not .com, but it is a very elevated speculative capital bubble rather than use terms like valuation. It's just you have too many people owning the same thing. And that's also been my criticism of gold. I actually think the gold thesis is incredibly rational. And I've written in my Substack that I think China is the driver of the gold theme for geopolitical reasons and a lot of other reasons. And they're going to be all in. They're going to continue to buy gold. But that doesn't change the fact that a bunch of people have concentrated in the same bet, and any correction is going to be violent and painful.
Yeah, we're gonna have to close it off because I think we're over time already. But I would just encourage people to read your piece on gold at the Global Watch Tower. That was an excellent piece, and I will add to your note of caution there, right? Like, gold does have a fundamental value that's determined by real interest rates and the value of the dollar, and maybe you think the dollar is going to, you know. Um, have a hyperinflation, and to earlier points, maybe there's some concerns around that. But I will just remind people that the Hunt brothers speculative bubble back in 1979, 1980, ended at a January 1980 high price of $875 an ounce, and that if you had bought then, you would not have seen gold at a higher price until January 2008. You would have
Yeah.
waited 28 years to get your money back. And oh, by the way, you would have been paying gold lease rates all that way. So you would have actually lost massive amounts of money.
Yeah. Now we do have China is famous for doing this in the commodity markets. It's the big, elephant or bull in the China shop. It buys the hell out of a commodity and creates this, price squeeze, like I wrote in the comment, that either draws everyone in or pushes everyone out. It has that effect on the commodity market, and it's treating gold a bit like that. But I do think its intention to buy gold is long term.
Yeah.
And so for those that are backing that theme, wait for pullbacks to buy rather than paying the highs.
Yeah, you might have to wait a long time for that pullback, is I think my point here. But and then I will leave our listeners with one final thought before we close, which is your point about concentration and the top 10 thematic ETFs that you highlighted from this Bank of America list. The one that struck me
Yeah.
is the one that is at the bottom of the list, still has decent returns for the year, but
Ah,
is global small cap value.
global small
That
cap.
is clearly not where there's a concentration because if you look at that, the global small cap, the MSCI Global Small Cap Value Index is nearly at its all-time low as a relative price versus the broader MSCI World Index right now. So, that strikes very well with the reindustrialization, the localization themes, and nobody seems to own it. So let's leave our listeners there, and we'll talk to everybody in 2 weeks, I guess.